Hello and welcome back to our channel. Today, we're diving into a topic that has intrigued and sometimes terrified investors for generations: stock market crashes, recessions, and the remarkable stories of recovery that follow. Stick around, because by the end of this video, you'll not only understand why these events happen but also how markets bounce back stronger than ever. Let's start with stock market crashes. A stock market crash is a sudden and severe drop in stock prices, often triggered by panic selling and underlying economic factors. One of the most infamous crashes was the Great Crash of 1929, which led to the Great Depression. In just a few days, the Dow Jones Industrial Average plummeted nearly 25%, wiping out billions of dollars in wealth. Another notable crash was the dot-com bubble burst in 2000. During the late 1990s, tech stocks soared to unprecedented heights, driven by speculation and the belief that the internet would revolutionize everything. But by March 2000, reality set in, and the market lost over $5 trillion in market value over the next 2 years. And who could forget the 2008 financial crisis? Sparked by the collapse of Lehman Brothers and a housing market meltdown, global markets went into freefall. The S&P 500 lost 57% of its value from its 2007 peak to its 2009 low. Now, let's talk about recessions. A recession is a significant decline in economic activity, lasting more than a few months. It's visible in GDP, real income, employment, industrial production, and wholesale retail sales. The Great Recession following the 2008 crisis was the worst economic downturn since the Great Depression. Unemployment soared, and millions of people lost their homes. But what causes recessions? They can be triggered by various factors, including high inflation, rising interest rates, reduced consumer confidence, and global events. For instance, the oil crisis in the 1970s led to stagflation, a period of high inflation and stagnant economic growth. Despite the doom and gloom, history shows that markets and economies recover. The recovery phase is marked by gradual improvement in economic indicators and rising stock prices. After the 1929 crash and subsequent Great Depression, it took years, but the market did eventually recover. The introduction of the New Deal by President Franklin D. Roosevelt helped restore confidence and stability. The dot-com bubble burst. By 2007, the market had not only recovered but was reaching new highs. Companies that survived the bust, like Amazon and eBay, went on to become giants. The 2008 financial crisis? By 2013, the S&P 500 had regained all its losses and continued to climb to new records. Measures like the Troubled Asset Relief Program, TARP, and the Federal Reserve's quantitative easing helped stabilize the economy and restore growth. So, what can we learn from these events? First, markets are cyclical. They go through periods of growth, contraction, and recovery. Second, diversification is crucial. Don't put all your eggs in one basket. Spread your investments across different asset classes to mitigate risk. Third, stay informed and remain calm. Panic selling can lock in losses and prevent you from benefiting from eventual recoveries. Lastly, have a long-term perspective. History shows that despite short-term volatility, markets tend to rise over the long term. Warren Buffett, one of the most successful investors of all time, advises to be fearful when others are greedy and greedy when others are fearful. In other words, don't follow the crowd, make informed decisions based on sound research. And there you have it. A brief journey through the world of stock market crashes, recessions, and the resilient recoveries that follow. If you found this video helpful, make sure to hit that like button, share it with your friends, and subscribe to our channel for more insights into the world of finance and investing. Thanks for watching and see you next time.